All right, a rally as they maybe make up 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Bassett. Katie Greifeld is on assignment, and Bloomberg Open Interest starts right now.
Slow but steady, the U.S. added 139,000 jobs in May, beating Wall Street's consensus. And Tesla shares are regaining some ground as the war of words de-escalates between Elon Musk and Donald Trump. We'll tell you all about it. But the day is young and nothing is certain, with reports saying that there are no plans for a makeup call between the White House and Elon Musk. Sonali, what are you... Well, I know you're watching.
I am watching Tesla because even though there might not be a call, Musk is stepping back from that ledge a little bit here. And because of that, you have Tesla a little higher this morning, only about 3.5%. You saw that public spat play out between Elon Musk and Donald Trump. President Trump play out. Those tensions have cooled after Musk saw his net worth drop $34 billion yesterday. And as Matt has pointed out to me, not only did they lose $50 billion in market value yesterday, but almost $200 billion in 2 days.
I mean, that's really all I'm watching as well, but we have to show you other stuff. So here is Broadcom, a chip supplier to companies like Apple. It gave a tepid sales forecast outside of AI chips, and as a result, the shares are down 3%. Sonali, we are focused, obviously, on this Musk spat, but today, the granddaddy of all economic statistics was served to us, and it was going in the right direction.
Yeah, it looks good for jobs. We're going to talk about that May jobs report. Matt had mentioned the U.S. added 139,000 jobs, and that beat expectation. The labor market continues to surprise to the upside, but there are signs of moderation. Take a listen to Stephanie Roth of Wolfe Research.
This is a period of time that was kind of peak uncertainty for the economy, given the tariff headwinds. So now looking ahead, we should anticipate that payroll gains are going to remain fairly solid throughout the course of this year. Now, they're going to slow down given the immigration trend, but we shouldn't expect an environment where the unemployment rate is rising significantly and we're in a real layoff situation. We should expect a steady slowdown in the pace of hiring just because immigration is going to be a big headwind, but the economy is going to be largely okay.
All right, Stephanie Roth there. And by the way, President Trump is tweeting right now. He just posted in all caps, America is so hot. 6 months ago, it was cold as ice. Border is closed. Prices are down. Wages are up. Joining us now to talk more about that, especially the average hourly earnings part of it, is Michael McKee. He's our international economics and policy correspondent, and he's not wrong. Month over month, wages increased.
He's not wrong. Wages increased, but year over year, they didn't change. So I'm not sure how important that is in the long run. 6 months ago, the economy was in pretty good shape. So we'll just dismiss that and give Stephanie Roth a promotion to playing the role of Kevin in Animal House. All is well. Kevin Bacon in Animal House. All
Some of
is
these
well.
references, Mike,
all
are
is
hitting
well.
home with me, but they're
Yes.
flying right over Sonali's head.
All right,
Everyone
we got to
loves
get her to
Kevin
watch the
Bacon,
movie.
though.
139,000 jobs created, better than expected, and that is a sign that while things are slowing down, they're not slowing down too much. And as Ms. Roth pointed out, 4.244% on a three-digit rate of unemployment is still very good. It is not anything that the Fed is going to have to worry about. You can see there the average hourly earnings numbers that Matt was talking about. Now, 93,000 jobs taken away over the last 2 months in March and April. That does also feed into the narrative that the economy is slowing but not falling off a cliff. If there's one takeaway from this that I thought was interesting, it was the drop in the labor force, 625,000 drop. That's the biggest since 2023. And the question we have is that because the administration has shut the southern border and we are not seeing a lot of illegal immigrants come in who then get into the labor force and take jobs? We did see a big drop in the number of people who got jobs in the household survey, which is one reason the unemployment rate stayed about the same. But it's an unanswered question at this point. And then finally, what were the biggest movers? Well, federal government finally shows some drops of 15,800. We've been waiting for that because of Doge. And then the rest of it is about as always. Healthcare and social services, the biggest gainer, 78,000. Food services, a healthy 30,000. And manufacturing falls by 8,000, which was hinted at in the ISM numbers. So the economy at this point is hanging in there. We're waiting to see if there are tariff effects, but we're still waiting for a lot of tariffs as well. So the two things combined has, well, put it this way, everybody can go back to worrying about Musk and Trump today and not the labor force.
Yes.
That's what Matt really wants to talk about. Mike, we thank you so very much. That is Michael McKee of Bloomberg. We're going to be looking forward to the CPI data next week after we saw that wage report as well. Let's bring in BlackRock's Chief Investment Officer of Global Fixed Income, Rick Rieder. Rick, we got a lot to talk about with you today. I do want to point out, it's interesting, you see yields across the curve quite higher. You see the 2-year flirting with 4% again, the 10-year flirting with about 4.5 nearly again, not quite there yet. What do you make of the report this morning and the direction of travel?
So I think there are a couple of things that are you know, as soon as our report comes out, there's two numbers that I look at, and they're a little bit different than others, is healthcare and education, leisure and hospitality. There's 139,000 jobs created. 135,000 of them came in those two sectors. We have a service economy. You know, the rest of it is sort of a little up, little down, pretty flattish. Yeah, an economy that's doing okay because the service economy is just doing all right. I have to say, I think that we'll start to see healthcare and education come off over the next couple of months. You need to see that, though, to open the door for the Fed to start cutting. But, you know, what markets are doing, they're repricing. You got inflation still above target, and you got an unemployment rate of 4.2-ish%. That is, you know, that's coming along okay. I mean, and, you know, you're not seeing the softness of any savings. Listen, when you say there's no softness, you are seeing some things about, you know, you look at the quits rate, the leavers, the job leavers. You look at the job postings, although JOLTS was okay. You saw the Indeed down a bit. So we are, if you say where we were versus where we are today, the trajectory is slower. The labor market is much more in balance, but it's certainly not deteriorating by any significance. So just, you know, if you're the Fed, you're just sitting on your hands for a while.
I mean, the service economy is the economy, right? I mean, Alan Patricoff was here a couple of weeks ago, and he was saying manufacturing is something like 8, maybe 9% of U.S. jobs. It's probably not going to go much higher, even if we see some serious reshoring, is it?
So, Matt, you know, I think, and we think we talked about last month, the month before, you know, people have been calling. Remember, we were pricing in the Fed cutting 5 times this year. The Fed would have to go 50 in June, and like this craziness. And it seems like every year, people say the economy's going into a recession, it's a deep recession, because I think people look at the analog from 20, 30 years ago, and when you had a more commodity-oriented, manufacturing-oriented economy, service economies generally don't go into a recession. Now, that being said, I did think you would get a month or two of a divot as in the economy because of companies would pull back on CapEx and R&D and see some pause there. But, you know, you're seeing a little bit of that. But, you know, look at these earnings numbers. You know, most are pretty good. Anything around it, you were talking about Broadcom. You know, you look at what's related to AI. Boy, I thought those numbers were pretty good for AI. Everything else a little bit soggier. So, anyway, I think the service economy, I think people grossly underestimate the U.S. resilience because it is a service economy.
You know, speaking of the service economy and the point that it's been holding on so far, there's still a lot of uncertainty out there, not just in the job market, but of course with inflation, the tit for tat with tariffs. This week was another kind of wrench in the up arrow story. Right now, we have less than 2 rate cuts priced into the market this year. I recall a conversation a couple of weeks ago I had with Rob Kaplan. He thinks maybe 1, maybe 0. Do you think that this is economy in need of rate cuts realistically, Rick?
So over the long term, I unequivocally think the Fed needs to get that rate down because the debt service in the country will be an issue if we don't get it. We keep rolling Treasury bills at elevated rates, so it's increasing the cost of debt to the country. And plus, you take the size of the deficit. So I do think they've got to get that rate down. The question is, when can they get it down? And today, I mean, I think it's really hard. Listen, I still think, and I said this 2 months ago, I still think they would like to get a couple of cuts done this year. And you got to see that deterioration in some of the labor conditions to see that. But I think they'd still like to get a couple done, and then you get into 26 and maybe have the window to get it down with some lower inflation numbers. By the way, things like productivity, automation kicking in, that'll start to bring inflation down. But, you know, for now, pretty hard to have them do that. But I think they should It's just, I think it's going to take a bit of time for that.
Rick, hang with us. We're going to talk more with you about tariffs, taxes, and Bink. But right now, I want to turn to the other big story of the day, the public battle that we saw erupt yesterday between Elon Musk and President Trump. There are signs of truce in the drama that unfolded on live television and on Twitter in real time. The dispute began over Musk's displeasure with President Trump's big, beautiful tax bill a few days ago, and it escalated into threats against political and business ventures. Jeffrey Epstein was brought up. Joining us now from Washington, D.C., senior White House reporter Josh Wingrove. Josh, it does look like Elon Musk backed down, also publicly, yesterday in tweets to, well, one tweet to someone that nobody's ever heard of, and then one tweet to Bill Ackman. But President Trump doesn't appear to have a phone call scheduled for Musk today, as Politico reported earlier. Is that the case?
Young love, guys. It's hard to see it break apart like this. You know, we all remember feeling so strongly at that age. The reporting right now for Politico is that there may be a call between staff and Musk. Our understanding that the president himself and Musk will not be speaking today, and the sort of détente seems to be coming more from one side, from Musk's side, than from Trump, who's like, you know, so over it, to be a little tongue-in-cheek this morning. Apparently, they're trying to figure out where to go from this. You know, on a more serious note, there are open questions here. So Musk has backed off the threat of the space program changes that would raise a lot of questions about the future of the International Space Station. Trump, though, has not really backed off, nor has he advanced his threat about taking a look at Elon's contracts and whether SpaceX or, you know, any of his companies that have federal contracts. So that's sort of a weapon that's sort of hanging in the air here that we don't really know whether Trump will reach for again today. Wall Street Journal reporting that Trump is looking to ditch his Tesla. Remember when he set up that de facto Tesla dealership on the south lawn of the White House? Bit of an unusual moment. He bought one of them, a red one. It's been sitting in the parking lot of the White House more or less since then, still sitting there today, according to some other colleagues of mine at other outlets. So Trump is maybe that's the way he's looking to respond to this, getting rid of his Tesla. But you know, this back and forth. These two had, you know, a very public-facing alliance, you might call it. You know, I don't even know if it was a friendship. I don't know that anyone knows that. But it really has gone off the rails, obviously. Musk looks like he's more willing to patch it up right now than Trump is.
Well, Josh, you know, and Matt, how much did Musk give to the last cycle again? I feel like
$290 million.
Right. It was a lot of money,
Yeah.
and now he's talking about the idea of another political party, and there's a lot
of money to us.
Yeah, a lot
it's
of money.
not nearly as much money to him, right?
Right, to him.
It's actually a pittance.
It's certainly a lot of money for the American public. And Josh, I'm really questioning what the intangibles are here. Yes, there are real things that the president could take away from Musk, but there's real havoc that Musk is causing when it comes to perception of certain plans of the Republican Party as well. He says he was going to back off on giving, but are there other ways he could look to influence the tax bill and then, by definition, the midterms too?
I mean, he's trying to get the tax bill derailed right now. I don't see a lot of appetite for that. You know, Musk has a lot of influence and will have a lot of influence. One of his tweets yesterday was, look, Trump's only going to be in office for 3.5 more years. I've got decades left. Republicans should be careful about whose side they choose. But, you know, it's a pretty empty room of Republicans right now who are lining up to align themselves with Elon Musk in a fight with Donald Trump, because Donald Trump can steer your primary very quickly in a way that Elon Musk's money can't, or at least as of now, they don't think it can. So, you know, we'll see whether Musk tries to start throwing his weight around in the Republican Party on that. I think it's just too soon to say, but derailing the tax bill, you know, forcing these actual conversations about impeachment, I think that's very far-fetched at this moment. There's just zero appetite among Republican lawmakers in Washington to go down that road, and so Musk might not have that immediate clout here. Trump seems to have a grip on the party.
Josh, I want to do a quick lightning round with you. So just yes or no answers, right?
Uh-oh.
Was there an EV mandate?
Kinda.
Did Trump need Elon Musk's support to win?
He benefited from it. I don't know that he needed it.
Did he ask Musk to leave, or did Musk's time just run out?
That's the multi-billion-dollar question. Right?
Are there really unreleased Epstein files?
I thought you guys knew that stuff. You know?
There seem to be so many questions here that are juicy enough to dig into, but nobody really wants to wade there. Josh Wingrove, thanks very much for your time. Appreciate it. Reporting from Washington. We're going to be back in just a moment with BlackRock's Rick Rieder after the break. This is Open Interest.
We're going to give you a check on those futures ahead of the opening bell. We are ending the week strong. There was strong economic data. The S&P 500 up 0.9%. A little bit of peace in the office, in the Oval Office for now, sort of, kind of. We are looking at yield soaring as well, not pictured here on the heels of that economic data. But the small caps also just ripping despite those higher yields. We are back now with BlackRock Chief Investment Officer of Global Fixed Income, Rick Rieder. Now, here's the thing. With Elon Musk's rift with the president, those Doge cuts that everyone was counting on to save all this money in the U.S. government, let alone the direction of the tax bill, how do you feel the prospects of those savings now?
Well, I don't know that that was necessarily instigant to really move the spending. Now, listen, when you look at the bills going through, listen, as a bondholder, you certainly would like to see greater spending cuts. You know, I think we're going down a path of the deficits are too large. What has to happen is we have to outgrow the debt in this country now because we're clearly not making the cuts in spending. Listen, I'm pretty enthusiastic about we are going to grow as an economy. And I actually think as you get in the back half of the year, I am sympathetic to the idea of deregulation, easier permitting, et cetera, will create some motivation to growth. And as I said, I think the economy and the spend on AI and data center and energy, power generally is pretty good. So anyway, but what it does is it says, you got one side of the ledger, that's the spending and the costs, and so now that one is going to be tricky for a bondholder. That one is tricky, particularly for long end interest rates. We just have to now count on the growth. It's got to be better. I have some sympathy for. I think it will happen, but anyway, I always hate when you can only use one side of the ledger, and that's where I feel we are today.
Howard Lutnick had a now kind of infamous banana back and forth with Representative Michelle Dean, and he seemed to be insisting that tariffs are a negotiating tool, and eventually they'll be down to zero. But the CBO said the tariff revenue could be $2.8 trillion over the next 10 years, and it does seem like Donald Trump for decades has wanted tariff revenue to replace tax revenue. So how do you think it's going to turn out? And, if it is revenue additive, isn't that good for reducing the deficit?
So, this is all tricky in terms of the elasticities of where it comes from, which countries, et cetera, how's it implemented. Listen, at the end of the day, there is revenue coming in, and when you look at the tax cuts and then you have most of the cost cutting that's back ended to 2029, et cetera. So yes, you are bringing in some revenues. That does create some offset. There's ambiguity around who pays for it, or debate or negotiation of who pays for it. But yes, it's real revenues. By the way, you've seen it come in. In the last few weeks, we have seen those revenues come in, and they're not nothing. It is real money. So listen, it's it's tricky to figure out elasticities. And I will say a couple of things around the U.S.-China dynamic for markets is going to be a big one because of the U.S. as well as Europe have functionally outsourced manufacturing to China for years. How does that, how do you transition that? How do you transition things like apparel and other places where trade is so acute between those countries? So anyway, we've got a keen eye on the China one. That's the one that's going to be a big deal for markets.
Now, I'm really curious about how you're playing the credit markets more largely. If you look up your ETF on the terminal, BINC US Equity, you can look up the holdings, and they're really interesting right now, I've got to say. I think I'm seeing a lot of Fannie and Freddie in here, Rick, in addition to high yields. I'm wondering if you can give us some color behind the trade.
You're pretty laser focused on that. That is right. Listen, I think this is a year, think about today. I don't think we're going to make any money of any significance in interest rates. What we're doing in the portfolios, we're running just under 3 years of interest rate exposure, 3 years of duration. Income works, and what we're trying to do is build a portfolio that's stable. We have added some mortgages, but what that does for us, it's got some spread to it, it's got some yield to it, and it keeps our credit quality high, keeps our liquidity in the portfolio high, but it lets us balance things like securitized assets, high yield. I like being a lender in Europe. if we can swap back assets in Europe, credit, high yield, investment grade, the portfolio is yielding about 6.7% today. And by the way, it's well into investment grade rated. Now, that's a pretty good portfolio as long as you can balance quality with where you're getting some yield, keep your liquidity high. It's a pretty, listen, I think this is as good an environment as I've ever seen to try and generate income in a portfolio and do it with stability. You don't have to be way out the yield curve and take the volatility like you're seeing today. You don't have to be way down the credit spectrum in a triple C high yield. And just keep good quality, diversify it, and keep a really nice yield. I mean, think about most pension funds, endowments, foundations. If you can hit 7 in stable fixed income, it's a pretty good opportunity.
Love the detail, great intel. Unfortunately, we don't have time for a lightning round with you, Rick. But thanks so much for joining us. BlackRock's Rick Rieder talking about the iShares Flexible Income ETF, BINC, BINC is the ticker. Still ahead, the view from the White House. Labor Secretary Lori Chavez-DeRemer joins the show with Anne-Marie Horton. This is Open Interest. Welcome back to Open Interest. I'm Matt Miller. Quick check on futures ahead of the opening bell, and we're showing some gains here as Tesla powers the S&P higher, futures at least, up 0.9%, up 1% on the NASDAQ. Maybe investors don't want to be even this weekend. They're going in long.
Yeah, they're seeking world peace, at least for the two most powerful men in America. Now, some more movers on our radar. A few other things that are mattering. We were talking about Tesla rebounding, now up 4.4%. Pre-market right into the open following yesterday's massive sell-off. We're going to speak with Pierre Ferragu at the open. Circle still soaring, Lululemon down. Stick with us. We're going to bring you all those stocks coming up at the opening bell. This is Open Interest.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are seeing a serious rise in futures. Right now, a 1% gain on S&P futures and on the NASDAQ, powered at least in part by Tesla after its massive collapse yesterday. Actually, over the past 2 days, we saw Tesla erase $200 billion in market cap because of a very public feud between its CEO, Elon Musk, and the President of the United States, Donald Trump. Opening bell on the New York Stock Exchange, the Generation Essentials, TGE, ringing the bell there to celebrate their IPO. Down at the NASDAQ, you have Omada, which is like a virtual healthcare stock. They brought the whole family. It's exciting, but no one cares about anything today other than the U.S. economy, right? We got the jobs numbers out, the granddaddy of all economic statistics, and this massive feud between Elon Musk and President Trump.
That feud that really roiled Tesla stock yesterday, now giving up a little bit today as Elon Musk really backs off the ledge here. Tesla is almost 5% right now, 4.7% higher at the market open. Remember, they lost $150 billion worth of market value yesterday on that very public SPAC. Tensions have cooled. Musk saw his own net worth drop $34 billion yesterday. Now, Wedbush analyst Dan Ives was on Bloomberg earlier. He does not anticipate this spat to last long.
It's like a frenemies in junior high school that's essentially going on between Trump and Musk. This is something where the friendship doesn't end. In other words, I still believe that this will be resolved potentially by the end of the day or by the weekend. And it's not our view that this changes the regulatory landscape for Musk when it comes to autonomous and the broader vision.
New Street Research Global Team Head of Technology Infrastructure, Pierre Ferragu, is a Tesla analyst and joins us now. And Pierre, this has to be one of those things. I mean, like, even for Elon Musk, it's pretty insane to go up against the president of the United States, especially when that president is Donald Trump. What do you make of it?
Well, you have to recognize, like, Elon is very, very sticking to his style and his character. Number one, he feels very much empowered. He's not afraid of taking any fight, even against, like, the president of the United States. And that's not uncommon. He took that kind of fight with, like, the previous president as well. And then you have also to remember that this is the way Elon Musk, reacts. That's his nature. And that's also the way he schemes up things, like in his business, in the way he manages influence on the system, he's very, very good at navigating the public opinion. And so the situation today is, bringing this fight on air and in social media and things like that. Part of that is a natural reaction of two people with very, very strong characters, very, very strong independent characters. And it's also a game between the two around, I think, the question that you mentioned, the US economy. Can we have this big bill and like an increased spending, increased deficit or not? And also, of course, like the fact that the influence of Elon Musk in the administration came to a point where there was probably a bit of a pushback on the political side of the administration.
Pierre, to the extent that at least part of this fight was around electric vehicle tax credits, for Elon Musk, is that fight worth it?
So that's very interesting that you say that, because that's an extremely unsubstantiated claim that everybody is doing this morning, making this morning, including Grok and like GPT-4o. But that's not true. Like, we've all known for many years, people who cover Tesla and understand the economics of Tesla, Elon Musk has claimed for many, many years that electric vehicle incentives are not really beneficial to Tesla, and that Tesla would actually be doing much better without them. So I don't think there is like any weight of these electric vehicle credits going away in the reaction of Elon Musk. I think the reaction is much more about his very well publicized concern about balancing out, the spending of the government, reducing the spending of the government. And this big, beautiful bill did quite the opposite.
Pierre, I really appreciate you joining us today at such short notice. Unfortunately, we have to run because we're going to talk to the U.S. Labor Secretary, but that was Pierre Ferragu there of New Street Research. Shonali, I was doing some kind of back-of-the-envelope calculations yesterday when Tesla was still worth over $1 trillion. So I looked at the entire auto industry outside of Tesla. Ford, GM, BMW, Mercedes, Volkswagen, Toyota, Honda, all of those together are worth $615 billion in market cap. Combined. And each car that they sell is worth about $16,000 in market cap. Now, Tesla is worth $1 trillion, and each car that they sell is worth about $600,000 in market cap, or was until yesterday's drop.
It's crazy. Tesla had lost a lot of value this year already as well, right? So you could hardly say that this year Trump was really good for it anyways.
That's true. That's true. Elon Musk has lost $100 billion since Trump came into office, just from the moves in the market cap of the caps of the company that he owns. But I just think it's interesting that Tesla is worth more than just car sales. There's something else, and Pierre would have said, and Dan Ives would say, anyone who follows the company, there's something more, a lot more than just car sales here.
And in the next hour, we're going to be covering a lot more of his private enterprises as well, Starlink and others. Now, we are going to switch conversations. We're going to switch gears. We're going to go to Anne-Marie Hordorn, Bloomberg's chief political correspondent and co-host of Surveillance, with an interview with the Labor Secretary. Listen in.
Well, we'd like to bring in the Labor Secretary now, Lori Chavez-DeRemer. Thank you so much, Secretary, for joining us as we are on the heels of this May report where the U.S. added 139,000 jobs, beating estimates. But I would love to start with the decline in the size of the labor force, down 626,000, largest drop since 2023. Is this because the administration has shut down immigration?
Well, thank you, Anne-Marie, for having me. We are excited, 139,000 new jobs, and that President Trump, with his dedication and his leadership, really has beat expectations for the third month in a row. Our goal is to grow this economy and grow this workforce, and the president has done a wonderful job in accessing companies to invest in the workforce, and we're seeing it across the country. So while jobs are continuing to grow, and we might see a decrease at the federal level, which is another great thing that we've seen 22,000 jobs leave the federal public workforce, and we're seeing it at the local level. So there's a lot to look forward to. There's a lot that we're excited about, and we couldn't be more excited for this economy in this third month in a row of a growing jobs report.
What do you think is behind, though, the drop in the size of the labor force?
Well, what we want is to grow that labor force. We're seeing increases in construction jobs. We're seeing increases in transportation and in healthcare, while the manufacturing sector is holding steady. What we're excited about is the focus that the president has on the skilled workforce. Again, my part of this equation is to grow that workforce. And as we transition through this process of onshoring, and the president has done a wonderful job in negotiating some of these tariff talks, tens of trillions of dollars are being invested. This workforce is going to continue to grow.
The unemployment rate remains steady. A lot of economists will point to the fact that potentially it's for the wrong reasons, not because jobs are plentiful, but because workers are dropping out. Are you concerned that too many workers are dropping out, especially in some of these areas that are mostly filled with immigrants?
Well, certainly what we have seen in the last few months is that native-born Americans are the ones where the job growth is happening. That's exciting for the American people. We want to make sure that we're protecting the American worker first, and we want that labor participation rate to go up. I will tell you, unemployment is holding steady. That is a good thing for the American economy. We'll continue to focus on that as the president's executive order with 1 million apprentices across the nation, and also through an executive order that we're going to have the skilled workforce with AI. I'm telling you, and I'm confident that that workforce is going to continue to grow, and we're going to see these numbers continue to climb and unemployment rate continue to drop.
Do you foresee wage pressures potentially reemerging to fill jobs if there are fewer immigrants coming to the United States, which is a policy of this administration?
Well, I can tell you right now that, wage growth, hourly wage growth is up almost 4%. That's great for the American people, more money in their pockets. And with this one big, beautiful bill that the president is focused on, we are going to see no tax on tips, no tax on overtime. Do you know what that does for a family of four who possibly can put more money in their pocket? I can tell you this, one big, beautiful bill equals one big, beautiful workforce. That's what I'm focused on, and I'm going to continue to work hard, get around this country, and deliver for the American people what the president promised them that he would do.
I guess my question, though, is if we have wage pressures reemerging, is there potentially a cycle where we can see higher inflation, makes it harder for things like the Federal Reserve to step in and potentially cut interest rates?
Well, certainly the president, again, is laser focused on growing the workforce. We're seeing unemployment hold steady. It's been holding steady for, really running between 4.0 and 4.2% over the last year. That's exciting for the American people. We are not seeing unemployment tick up. We're seeing hourly wage growth go up. That's, again, good for them. I'll be working with the president on this to make sure that we can continue to hold steady and grow this economy.
The president posted on social media that America is, quote, hot, and he said 6 months ago it was ice cold. But 6 months ago, I'm looking at the non-farm payroll numbers from 6 months ago, we were at 323,000, and an unemployment rate even lower than we are today of 4.1%. That is what arguably many people would call a hot labor market. What is the president talking about when he says we weren't hot?
Well, under the last administration, we saw, for instance, manufacturing jobs take a tank over the last 20 years. That is what the president is bringing back. Hardworking, blue-collar Americans, where he's bringing labor and business together to grow the economy for the everyday average American. That's where the change in the focus has been. And so the labor market is growing steady, and he's correct. It is hot, and it is better than what we had in the past administration, 100%.
But manufacturing payroll numbers dropped 8,000 for the month of May.
But compared to the Biden administration, they've grown. They have continued to hold steady. That is the difference when he stays laser focused on the American people and the American worker. I'm telling you, as I go around this country and I visit, the excitement in the labor force and in the participation rate, we're seeing that increase. Students, young people, they're excited to get back into the labor market. So it's going to take some time. But I can tell you, if we stay focused on the American people, I don't make a decision at the Department of Labor unless I know it's going to benefit the American worker first.
You mentioned federal workers and those employment numbers dropping off. When you think about DOGE working inside the labor force, has it changed given the fact that Elon Musk has now left the administration, and also given the fact that he's having this pretty massive breakup with the President of the United States on social media?
Well, the focus of DOGE was government efficiency. Again, that's what the president promised the American people, that he was going to save them their hard-earned tax dollars. Again, the focus is to make sure that we're being efficient with their tax dollars and still growing the economy. Listen, we can have distractions all day long. This jobs report of 139,000 new jobs, I think, is the primary focus today, because that is what matters to the everyday workers who get up every morning and understand that the president has their best interests at heart.
So even with Elon Musk not at the helm and also having this implosion with President Trump, do you still see DOGE working even inside the Labor Department?
Well, government efficiency, I think, is key. And I think for every secretary of every agency, we're going to continue to DOGE our own agencies. Because, again, for the American people, they want to understand that when we have their hard-earned tax dollars, that we're spending it wisely and we're saving them dollars where there's inefficiencies. And I'll continue to focus on DOGing my own agency to make sure that we're saving the American tax dollars.
Well, we look forward to hearing about those numbers, Secretary. Just finally, the president has taken to social media again this morning, and he's saying too late, the Fed is a disaster. He's looking at what Jay Powell is doing, comparing it to Europe, which has already cut interest rates a number of times. And he says, despite them, though, our country is still doing great. Why would the Federal Reserve need to be cutting interest rates when you're telling us that this is a really fantastic and healthy labor market?
Well, that's the focus, right? And sometimes you gotta have the stool stand on several different legs. The president does a wonderful job at negotiations. The president will have a conversation with the Treasury Secretary, and he will determine when it's time to put the pressure on to lower those interest rates to make sure that we're still adding to the American economy and protecting the American worker.
Thanks so much for joining us, Labor Secretary Lori Chavez-DeRemer. Really appreciate your time. Shonali and Matt, I'll send things back to you.
We thank you so much, Anne-Marie. What a terrific interview, of course. State of the labor market in flux. That was Bloomberg's Anne-Marie Horridor with the Labor Secretary. Want to bring back that quote from the president on Truth Social. Too late at the Fed is a disaster. Europe has had 10 rate cuts. We have had none. Despite him, our country is doing great. Go for a full point, he says. Rocket fuel. I want to pull up also what the market says, because that matters too. You have less than 2 rate cuts actually this year that already priced in. So nowhere near what the president is talking about. Of course, it's because we have still seen an economy that has been hotter than expected. We had also seen a little earlier the president say that the economy is indeed hot. Now, people are going to be looking very closely at that inflation data next week. But in the meantime, we are looking at a market that is still ripping. Let's get a check on some of those movers, too, because Tesla is helping out at that easing of the spat between billionaire Elon Musk and President Trump is now sending Tesla shares about 5% higher, about 4.95%. But big tech also leading the way on a points basis. Nvidia at the top of the group. Apple, Amazon not far behind. On the downside, we do see Broadcom, Lululemon taking a hit, with Broadcom still down about 2.5%. And Lululemon, an absolutely bruising nearly 19%, but still a broad-based rally here on our hands. Consumer discretionary leading the way. That jobs data certainly helps, Matt. We are seeing risk on heading into the weekend. That labor data this morning setting the market back on a tear.
Yeah, absolutely on fire today. Shonali, thanks very much for that. Coming up, earnings season finally winds down. Shonali will disagree with me, but earnings season is coming to an end. Shares are soaring today at Rent the Runway as the company's inventory bet pays off. You can see they're going the other way of Lululemon and then some. We speak to Jennifer Hyman, Rent the Runway's CEO, next. This is Open Interest.
And it's time now for our top calls. Some of the analysts' action in focus this morning. First up, we're looking at CrowdStrike being downgraded at Bernstein, saying that the stock is too expensive. The analyst says that investors have crowded into the cybersecurity sector as a whole, perceiving it as a relative safe haven. And next up, McDonald's getting cut at Loop Capital. The reason? Chicken strips. The relaunched menu item has gotten a lot of negative customer feedback. You know, some of us still just like those tendies. I suppose. Finally, Urban Outfitters is getting upgraded at Jefferies. The firm says its brands are still driving sales growth with healthy trajectories ahead. Still facing a lot of softness since those earnings. But we're going to talk about a positive story now. Rent the Runway shares just soaring. Subscriber base is growing again. The fashion business is reworking its business model to improve the product offering and boost customer retention. Joining us now, Jennifer Hyman, the CEO of Rent the Runway. What a great morning at Rent the Runway today.
Hi, it is. You know, record loyalty. So loyalty is the highest it's been in 4 years. Record active sub count, record sequential growth in subscribers. We're feeling really, really great about the corporate transformation we put into place.
So something that's funny is Matt, I think, knows this habit of mine. I'm a stress shopper. Whenever I'm stressed out, I go shopping. But the problem is lately...
she's stressed a lot.
Yes, yeah, it's a big problem. But there's got to be a limit here. It is not a great moment for a consumer wallet. I'm wondering how Rent the Runway tends to behave in those kinds of environments. Do you find actually increased engagement because people shouldn't be buying as much as I've been buying the last 2 years?
I think the tailwinds for rental and resale are higher than they've ever been because our business is about financial value. The customer is getting thousands of dollars worth of clothing per month for a really low price. Our subscription price points start at sub $100. We have different kinds of programs for different kinds of customers. And I think that for the customer who's still going into work, she has to have variety in her wardrobe. She wants to look great. This is the best way to do it from a financial standpoint. So as tariffs might affect the industry, as people get more concerned with pricing, saving money via rental and resale, I think is going to boost the rental industry overall.
Is this, by the way, a recession play? I mean, is that what's happening here? Because I don't know much about the business of women's fashion, but I look at your stock over the last 5 years, it's been crushed. Over the last 3 months, it's doubled. So is that because everyone's saying, oh, we're going to go into a recession, I can't buy my, I don't know, Dior or, I don't know,
You're on the right.
YSL, right? And so I'm going to rent it instead.
I mean, I think that our business really proved out in 2024 that the unit economics make sense and this business works financially. We brought the business to nearly free cash flow break even. And then 2025 was really about proving to the world that we can grow. And how are we focused on growth? We've doubled our inventory this year, which has led to huge growth in loyalty. We have made huge improvements in product, which are improving the customer experience. And we've kind of driven the business back to a much more authentic way of communicating with our customers, which has driven up social engagement by 163%. So we're not investing more in marketing, but we've changed the way that we talk to our consumers, and that's having a positive effect.
You know what's so interesting to me? When you talk about typical retail companies, you're talking about the brick and mortar presence, you're talking about the same store sales. But when it comes to you, we talk a lot about you like a social media company. The idea here now that you have almost 150,000 active subscribers. What does that look like in 1 year, 2 years from now? Do you have a sense of how far that could go and what that consumer loyalty gets you?
Yeah, one of the most exciting things about the business is that for so many years, we were trying to convince the world, the market, that they should rent clothes. And now this is a mainstream behavior that women are considering for how they get dressed in their daily lives. And so the opportunity to have millions of subscribers in the future to Rent the Runway, I think, is really bright.
Yeah, I see. You gave me an idea to look it up on Instagram, right? You have over 500,000 followers there.
That's where I shop the most.
And probably on TikTok, and I don't know these channels, but can you turn those followers into subscribers relatively easily?
I think that the way to do that is actually via inventory. So we've moved to a place in the market where we're out of the early adopter phase. And now people are choosing where to rent based on the brands that we carry, based on the styles that we have. So really investing in kind of doubling our new inventory, adding 90 new brands this year, kind of more than doubling the inventory from our top 25 brands, and being a partner for our brands to help them acquire new customers. So brands are willing to work with us in this incredible way where 70% of our inventory is either via revenue share or via exclusive designs where we're not paying large amounts of capital up front. So we've really flipped the model of how a traditional retailer might work into one where we're revenue sharing with our partners on the performance of the inventory.
All right. I think it's really a really cool business, and I mean, you look amazing. So
Thank
I kind of want to
you.
rent the runway, but you don't have suits, right?
We can up your tie collection.
Yes, you should
That's
do
what
a
we
rent the
could
runway
do.
for ties.
Well, you know what? I want your wife as a customer. I want your friends as customers. Spread the word. I think that Rent the Runway has really grown based on organic adoption from the very beginning, word of mouth, and igniting the authenticity around the brand. The inventory helps do that because you look great, you get a compliment, you say, I rented the runway, and now you're going to be a customer.
All right, Jennifer, thanks so much for joining us. Jennifer Hyman there of Rent the Runway. Another truth dropping just now from Donald Trump, or during that interview that Anne-Marie did with Lori Chavez-DeRemer. If too late at the Fed would cut, we would greatly reduce interest rates, long and short, on debt that is coming due. Biden went mostly short term. There is virtually no inflation anymore. But if it should come back, raise rate to counter. Very simple. He is costing our country a fortune.
I want to be very clear that the Treasury Secretary currently is also having to borrow at the short term.
Yes, I know.
Right? Like, let's remember that.
Right. And also, if this economy is so hot, if we're running hot, do you want to cut rates? That's not really how it works.
Keeping them too high.
Coming up next, we'll talk to Diane Swank about this from KPMG. She shares her prediction for the U.S. economy. And then we'll talk whether this Tesla drop is an opportunity for Rivian with Charles Lemonides. This is Bloomberg. We are 30 minutes into the trading day, looking at gains on pretty big gains on the indexes. S&P 500 up over 6,000, Shanali. Right now, looking at 1.2%. Obviously, we are now in official bull market territory, right ahead of the launch of your new show, Bullish. NASDAQ gaining 1.2% as well. And this is what I find interesting, this as the 10-year yield gets back towards the so-called danger zone, right? You made the point earlier, the Russell 2000, the small caps are gaining even more than the mega caps, and as interest rates rise, that shouldn't be the case.
Incredible scenario that we're looking at. Let's see if it holds. But coming up, slow but steady, the U.S. added 139,000 jobs in May, explaining that increase in yields, it beat consensus while showing gradual moderation.
That jobs report has got President Trump all fired up. The president urging the Fed to cut rates by a full point, piling the pressure on Powell, even as he says, this economy is so hot.
So hot. Meanwhile, the White House is signaling that the president may move on from his feud with Musk. But the Wall Street Journal says that Trump is considering selling or giving away his Tesla shares. Before we get back to that, can we just marinate 1 second on S&P 500 at 6,000?
Yeah, pretty unbelievable that we're back so quickly, right? The February 19th high was 61.44, and then we fell, obviously, 20% from that after the Liberation Day tariffs, and we're almost all the way back there now.
Yeah, let's see if we hold there through the close, but pretty fascinating. We finally got back there. Let's see if it sets off some new risk appetite.
All right, joining us now as a wild week for President Trump comes to an end with a positive jobs report is Diane Swank, chief economist at KPMG. And Diane, I just want to, well, first of all, thank you for joining us. Happy Friday. This was a very long week. The jobs numbers look pretty positive. Indeed, President Trump is saying America is so hot compared to how ice cold it was 6 months ago. In that case, do we really need the Fed to be cutting now?
Well, actually, I think the job numbers were had a soft underbelly to them that is getting lost in translation. But no, the Fed's not going to cut at this stage of the game because of the threat that tariffs pose to inflation. And they've been very clear about that. They have to deal with that threat first. And without dealing with taming inflation due to tariffs, you cannot get to full employment sustained. And so that is the bottom line for the Federal Reserve. But the soft underbelly in this report was the household survey. The household survey shed a lot of jobs, but really what we saw was other shifts in the household survey that suggest, along with the slowdown in the pace of hiring, which is very low right now. The pace of hiring is below that we saw in 2019, so are quit rates, and people leaving their jobs fell by quite a bit during the month, while people trying to get education and training and moving out of the labor force for that picked up. That tends to be a sign, an early sign of a weakening labor market where people are not as able to get jobs as quickly as they once did. The ranks of the newly unemployed also picked up. So even though the overall number is solid and beat expectations, with revisions, it's weaker. And the underbelly of what's going on in terms of the household survey revealed an economy that's the labor market starting to look very fragile. There's not a lot of room for error when the pace of hiring is so low and quit rates are so low. Any increase in layoffs will result in a rise in unemployment. And in fact, the main reason the unemployment rate did not rise was because there was a drop in the participation rate. That's not for the right reasons. Fewer people were actually putting their hat in the ring and looking for jobs during the month.
Dan, the caution is so very warranted, but I do want to also point out what the president is saying this morning, because he said too late at the Fed is a disaster. Europe has had 10 rate cuts. I will point out they did not have 10, they had 8. We have had none, he says. Despite him, our country is doing great. Then he says, go for a full point, rocket fuel. He is asking for a full point rate cut, and of course, even just a half point rate cut last year was a big deal. The Fed has not been able to do that since, and the market is doubting that they could do 2 this year, maybe 1, some believe 0. If he were to cut a full point, can you just paint a picture quickly here about what that would do to the economy, given the inflation concerns?
Well, we really have seen a decoupling between the Treasury bond market and the equity market, as you already noted, where Treasury bond yields are moving up. There sort of is a sheen has come off the dollar as a reserve currency in the Treasury bond market as the safe haven that it once was. And I think that's very important, because anything the Fed were to do, if the Fed were to suddenly cut, the Treasury bond yields would likely spike even more. That is what the Treasury bond market is telling us. They're not going to wait around. The bond vigilantes have returned. Investors are making up a larger share of the Treasury bond market. They're much more price sensitive, and they're requiring compensation for the risk that inflation will pick up and the fact that our deficits are so large. That is very different than anything we've seen in recent decades, and the exact opposite of what we saw in the height of the global financial crisis in 2008 and 2009, when even as we exported a subprime crisis to the entire global economy, the rush was still into the safety of the U.S. Treasury bond market, and investors were willing to pay us to take on debt, even though we were the epicenter of that crisis.
It's funny, yesterday Elon Musk tweeted out retweeted a series of tweets from President Trump during the Obama era, in which President Trump was a deficit hawk and saying that we shouldn't be raising the debt ceiling. Now, clearly he feels differently, but how big a deficit or how much do you think, Diane, President Trump and his big, beautiful bill will add to the national debt? The CBO said $2.5 trillion. I've heard estimates that are closer to like $5.3 trillion. On the other hand, if he does keep a 10%, baseline tariff, the CBO says he's going to bring in about $2.8 trillion to offset that.
So we do expect at least $2.5 to $3 trillion on the deficit, and I would expect more than that, because I don't think all of the Medicaid cuts that are backloaded are going to make it through the Senate. Those particularly hit rural areas that happen to be very heavily dominated by Republican districts, and so I think it's very hard to pull back. Women and children are the most at risk from those Medicaid cuts, and they're backloaded into the very end of the bill, but I think those are going to be very hard for the Senate to swallow, which means with the expansions and extensions to tax cuts that we have out there, the deficit will be even larger. We've also seen a massive move in the month of April where baby boomers who were hoping to hold off and get a larger payment on their Social Security are taking their Social Security early rather than waiting for their Social Security benefits, because they actually are afraid that those benefits will be cut later on. So I think that's another sign of how much different the view is in both the U.S. economy and from those buying our debt of federal deficits and debt. Adding to them at this stage is not the best thing to be doing, but that is really what's going on. And the tariffs alone, the math just doesn't add up. to cover the costs of tax cuts elsewhere.
Diane, we thank you so much for joining us this morning. Of course, a lot to parse through as we can start the drumbeat, can't we? About a week and a half now to Fed Day. Yeah, for sure. And it'll be interesting to see. Obviously, we don't expect the Fed to cut, and we don't expect the Fed to cut that much anymore. In terms of pricing, you're saying now fewer than two cuts? Fewer than two. Yeah. And that September rate cut very seriously in dispute as well. We'll keep an eye on all of that to you. But let's get back to the story stealing all the headlines. Tesla shares trying to bounce back after yesterday's sell-off. Elon Musk saw his net worth crumble by $34 billion by the end of trading yesterday. Joining us now from San Francisco, Bloomberg technology co-host Ed Ludlow. Ed, we've been talking a lot about Tesla. I'm actually curious about the broader Musk world because, of course, Starlink came under threat as well. What does it mean for this billionaire to get into such a massive dispute with the president? How much is at risk for him?
Yeah, look, if you think about like Elon Inc., right, Tesla, the sort of public proxy, and we can talk about the trading, or SpaceX, the sort of dominant player, the dominant, it has basically a monopoly in commercial space launch. It has massive exposure to the US government. You know, Tesla's history was built on some element of subsidy, particularly in more recent years with the EV tax credit. Now, Elon Musk has said very, very consistently that they should do away with subsidies and EV tax credits. On the SpaceX side, it is highly aligned with the defense apparatus of this country. Billions of dollars of contracts, not just grants that come from NASA for projects, but I'm talking deals with the Pentagon and other institutions to put defense satellites into orbit. But the way I look at it right now is like the stock's down on the basis of having its worst weekly drop since October of 2023. So this is really big. And it's specifically relating to what's at the core of the long-term Tesla bull thesis, which was the Trump trade of Elon being friends with the president and affecting legislation or policy that would be to Tesla's benefit. And that's kind of what the market's digesting right now.
I wonder if you've seen the acronym MAKO. Musk always chickens out because he initially said he was going to decommission the Dragon, and then he tweeted back to somebody who had like 117 followers, maybe I won't do that. He initially said he was going to cut $2 trillion from the deficit, and now what has he got so far under Doge, Ed? How much have they actually cut?
Well, this is what the thesis is of some, particularly I think in markets outside of Tesla, you know, who are trying to track what the president does next. And I think, you know, there's an idea that Musk is trying to put emphasis back on the deficit because he basically is also consistent on the idea of the debt burden of the United States. This was a big thing in the campaign, and like a lot of the exchange on X, I just don't think we have time to go through the blow by blow, but he kind of steered it back to the idea that during the campaign ahead of the November election, Musk was quite helpful to Trump, and they were aligned on the idea that they had to address that deficit and bring it down. But again, like from the technology and Tesla perspective, for me, this is a robo-taxi story. This is a story about Elon Musk's relationship with the president and how he had hoped to, as we've reported, get some legislation through and some federal framework that would make it easier for Tesla to get purpose-built robo-taxis on American roads. And the trading of the last two sessions reflects a rethink maybe for some on that long-term bull thesis of the robo-taxi.
Ed, really quickly here, too, what do you think that this means in terms of Musk's influence on American politics moving forward? Does it embolden him, or does it knock him down?
Yeah, I'll answer your question with a question, which is if you are a Tesla shareholder that sold stock on Thursday, were you selling because you are concerned about Tesla, or were you selling as a bet against Elon Musk specifically? Because remember, Tesla's a ginormous company with a lot of people who are very talented and very smart leading it, while Elon has his focus on a multitude of companies. And so I think that's, you know, with the buy-side names that we get on, and even the retail investors that are watching this show, like, you know, engaging with them, that's a question a lot of people are asking themselves.
Ed, thanks very much. Ed Ludlow there, Bloomberg Technology co-host. And by the way, Ed, you did an amazing job covering this story yesterday because I was listening to you on the radio and then I switched over to watch you on TV and I just couldn't take my eyes off this story.
No one knows more about
I was standing, Shonali, next to a woman in the Department of Motor Vehicles. I was standing in line at the DMV.
I'm sorry you had to go.
And a woman that I didn't even know was like, oh my God, have you seen this Musk story? And we were like talking about it the whole time.
Yeah, my family, who cares nothing about what I do, was also asking me too.
It was
the world by storm.
Incredible, and looks like it's going to peter out a little bit now. Let's get a look at some of the other single stocks moving at this hour. Shares of Broadcom are lower after giving a forecast that wasn't seen as strong enough. Lululemon absolutely plummeting, losing a fifth of its value. Does that make sense?
It's crazy. I mean, at the end of the day, Lululemon is pricey yoga pants, right? And it's an interesting economy. Maybe the job market is holding strong, but are they buying everywhere? It's a market where you're seeing Lulu down by almost 20 and Rent the Runway up by another 20.
And Circle after that insane IPO.
You know, it's worth 3 times more than what it IPO'd at, more than 3 times more.
Yeah, $31 was
a
the
share.
IPO price, and now it's worth over $100.
Correct. Just incredible. Let's see how that holds. But coming up, we're going to talk next to Charles Lemonides. He's Valueworks' founder. He's going to give us his thoughts on the Musk-Trump feud, what it means for investors, and a few more of his trades. We're going to talk about that next in the Wall Street Beat. This is Bloomberg Open Interest.
Let's get out of high interest. Look at what's making headlines around the world. President Trump is telling Senate Republicans he's open to a state and local tax deduction cap that's lower than the $40,000 the House passed version of his tax bill. His comments are adding momentum to Senate GOP efforts to establish a lower SALT cap. Speaker Mike Johnson says he's fighting to keep the $40,000 cap because it'll be crucial to passing the final bill version of the bill. Remember that President Trump campaigned here in New York and said he was going to lift that SALT cap. So I guess he's not. Elon Musk's Starlink has received approval in India, paving the way for rolling out its satellite internet services in the world's most populous country. The approval caps a years-long wait for the company, a crucial opportunity, especially since it continues to be shut out of China. Starlink's entry will also break new ground for India, where internet connections are primarily obtained through cell towers and fiber cable, so a whole new third way, Shonali, to get internet in India.
Yeah, I was old enough to remember when it was very difficult to lay fiber lines in India, Matt. Of course, monsoon season is hot and heavy, makes it difficult to dig. Now, but we're going to switch gears. It's time now for the Wall Street Beat. We're going to talk about other parts of the Elon Musk world. Joining us now, Charles Lemonides. He's Chief Investment Officer and founder of Valueworks. Valueworks holds some names that are atypical for value investors, such as Rivian. And the firm has also held Fannie Freddie preferred since 2009. So a lot going on in this market that impacts you right now.
A lot going on in this market that impacts us right now. It's been a really dynamic moment.
So Tesla, let's talk about that first. Given the fallout between Elon Musk and President Trump, what do you do around this? Would you consider shorting Tesla? Would you actually buy the dip that you saw yesterday? Do you go to any of its rivals? How do you play that?
We think electrification is real. We think there are great ways to play electrification. We think electric cars are the future. We don't think Tesla's a great stock as a surrogate for a cult of personality. Look, it's priced at $1 trillion because people believe that Elon Musk's stock should be priced that way. You could try to make believe you're giving it valuations that justify that, but they're a lie. But if you try to short a cult of personality, you have a risk of going bust. So from my perspective, it's more a point of interest, and if you want to be a gambler, gamble on Tesla one way or the other. If you want to invest in electrification, there are much better choices.
So Rivian is a stock that you own, and I guess they could take market share from Tesla, although the big seller for Tesla is the cheapest car, right? The Model Y, which is like you can get for $35,000. Rivian is like $80,000 to get in. So are they going to change that?
Well, Rivian, I think, was smart in that the first car they brought to market was a super high-end vehicle, and I think it's the best vehicle that you could drive. And I drive it, You know, I'm a hedge fund manager from New York. I could probably drive whatever I like.
R1S or R1T?
The SUV thing, I
R1S,
guess, right?
yes.
Okay. That said, their next rollout is something that's going to be in the $50,000-ish price point, which I think is the sweet spot for cars. And that's going to be a mass market car, looking at 200, 300,000 cars a year over the next 2 years from now. The big one that I drive, they're doing 50,000 cars. They might get to 70,000 of those, but that's still a good business. And the long-term trajectory is really, really powerful.
What about General Motors? I mean, yes, they make the lion's share of their money. They make all their money on the big trucks, gas-guzzling trucks, but they have a pretty impressive electric vehicle lineup. They're coming out with a new Bolt, and the old Bolt was already a strong seller. They have the GMC Hummer, the Sierra and Silverado EVs. I just drove the Blazer EV, which was an absolute sleeper.
So the EVs are coming, and the more that we understand that range isn't an issue and you could charge them, the more they're on their way. They're a more powerful option than an internal combustion engine, I'm pretty sure. So the question is, like, is a standalone EV maker better positioned than one that has to defend their internal combustion engine business? And that's a big investment for the other automakers, and it sort of puts them needing to defend something that's gonna die. So I think you're better served with the standalone, and I think that Rivian will be only one of 2 standalones, because the other independent EV makers don't have the scale that Rivian has. And if you're not sure they're going to be around, and one of them just went bust, another one is likely to go bust soon, yeah, it's really hard to commit to spending 50, 100 grand on a car if the manufacturer goes bust and you know, if a light goes on and you can't drive your car
A lot
anymore.
of risk in this transformation. We only have about a minute left here. I do want to quickly get your thoughts here on something I realize you've owned for a long time, Fannie Freddie. You've been in the preferreds. How do you think that the preferreds versus commons will do if the government succeeds in privatizing it?
Well, look, the nice thing
in bringing it more public.
publicizing, bringing it public,
other way around.
deprivatizing,
Yes, deprivatizing.
right.
Thank you.
The nice thing about the preferreds is you can have a target price for them. You can have an estimate of where they'll trade if this comes to pass, because they're preferred stocks. They're legally entitled to a dividend rate, and so they're likely to trade based on yield, which, you know, depending upon which one you're talking about, they'll be basically 2.5 times today's price if they're paying the dividends and the company has equity value below you. The challenge with the equity is that the government can take whatever percentage of the equity they want for themselves. So when you buy the stock in the open market today, you're maybe getting 20% of the shares outstanding, because the government has warrants to buy another 80%. But the government also has a preferred stock that they could easily convert into another 80% of the common, or 200% of what's outstanding on the common.
Charles, fascinating stuff. I hope we can have you back soon to talk more because you hold a lot of really interesting stocks. Charles Lemonides there of Valueworks. This is Bloomberg.
This is a disaster for Musk. I don't know if I can spin it in a positive way, because it's just so beyond any intelligent businessman's behavior would be. I can't imagine, after putting Trump in there, that he would then turn Trump into an enemy of all things, because he's still the president of the United States.
That was Ross Gerber, President and CEO of Gerber Kawasaki, one of Tesla's earliest investor, talking to Bloomberg yesterday. Here's a timeline of yesterday afternoon's stock moves. You can see at 12:59, Trump spoke. At 1:57, Elon tweeted. Then Trump tweets back. And meanwhile, the stock is just plummeting the whole time, right? Now, it has rebounded pretty significantly today. Obviously, we haven't got all $200 billion of market cap back that was lost over the last couple of days. But let's get more on this story. We're joined by Bloomberg's Detroit bureau chief, David Welch. David, it is pretty amazing to see that much market cap disappear from a company with no corporate news to speak of. Does it look like Elon Musk can make this back if he makes up with President Trump?
It's going to have to be a pretty big makeup. Look, I think one of the things that had pushed Tesla's stock rally, going back to pre-inauguration, we're talking pre-election, as a matter of fact, when Trump was doing better in polls and Musk was aligned with him, there was an assumption out there that Trump would clear the way for AI, clear the way for autonomous vehicles, and maybe Elon would be able to preserve some of the electric vehicle credits by being, sitting right next to Trump, sitting on his shoulder and being the Trump whisperer for the industry. And that it actually would probably benefit Tesla much more than all the other car companies because Elon would be able to make all of this happen. And here we are, the Republican bill is still taking away electric vehicle credits. We do have some movement on new legislation for autonomous vehicles, but it's very unclear at the moment. And I think, between the tariffs and between the electric vehicle credits going away, Elon kind of figured that being so close to Trump, spending so much time and money, getting him elected, that he would have gotten his way on these issues, and he didn't. And I think, hence David, the tantrum and the counter tantrum.
Can I ask a question? Donald Trump keeps saying that he took away the EV mandate. Now, he also says we gave $350 billion to Ukraine and that the ECB cut 10 times, neither of which is true. But was there a mandate, an EV mandate from the federal government?
What they mean by the EV mandate when Republicans talk about that is the clean air rules that govern fuel economy and greenhouse gas emissions that by default, because of the toughness of those rules, would have required about half the vehicles in the U.S. sold be electric by 2032, which at the pace we're going was just not realistic. The EV credits are not a mandate. They give money to people to buy them, and they give money to companies who produce batteries in the U.S. But it wasn't a rule saying anyone had to buy EVs. It was just forcing automakers to sell a certain number of them. And look, we've seen these done in California over the years on hybrids, on EVs. The government's always backed off on them whenever the market didn't respond to it. And so there was a mandate of sorts on that, but it wasn't requiring individual consumers to do it. But it was a very, very unrealistic regulation on the car companies. You're talking about product cycles that are 1 or 2 vehicles away, new models away, and the market's at 8% EVs, and they're requiring it to be half. And it was just too tough to hit, and that's where the whole mandate thing came about.
Back in May, I suppose at this point, you had Elon Musk speaking with our own Michelle Hussein, saying that he was kind of going to back off from the political funding side of things. And Tesla itself, over the last few months, has increasingly gotten very politicized because of Musk's relationship to the president, his own political activity over the last couple of years. I mean, how did the politics of Tesla change, given the latest turn we've seen in this saga?
Look, Elon is, I've always thought, not necessarily a liberal supporting clean air rules and incentives from the government, not necessarily a true conservative. It's really politics of Elon. I do think for a variety of reasons, when he went on X, he opposed certain social issues, basically diversity and woke politics that come from the left. He didn't like those things. And I think he was just more aligned with Trump in a lot of ways, probably also because the Biden administration had gone after autopilot and the safety issues that Tesla's had. He didn't like that either. Elon doesn't really like regulation. And so I think he lashed himself to Trump, figuring that this was going to help his business. And by the way, there were a bunch of social issues where he didn't agree with the Democrats. And that's cost him some sales, right? Does this all turn it about now that he's fighting with Trump? Probably not, because I think there are a lot of buyers who he's probably permanently turned away unless he were to just completely reverse course and go full progressive here, which I just don't think he believes in a lot of those social issues, so he's not going to do it. I don't think there's much coming back from it here. I think what he needs to do if he's going to win buyers back is just stop talking about politics. I mean, there's a reason you don't see other CEOs who make products that they need to sell in big volume out there talking politics a lot. Yeah. They'll sell a product to anybody, and they don't want to offend people.
Famous lesson from Michael Jordan. David Welch, thank you so much for joining us, our Detroit bureau chief, David Welch, on Tesla. I want to shift gears to another automaker, which I can say without it being a horrible pun, because you can't shift gears in an electric car, but
oh yeah, I just caught that.
you
Sorry.
can
Took me a minute.
the Infiniti QX60. That's Nissan's luxury vehicle division, Infiniti, and they are making the QX60 vehicle in Smyrna, Tennessee,
yes.
I believe.
Yep,
we
that's
go
correct.
there now to talk to the head of the Americas business, Tiago Castro. Tiago, thanks for joining us. Talk to us about the fact that you're manufacturing these vehicles in America. And it's not new for you to make vehicles, or for Nissan to make vehicles in America, but are you bringing more of your manufacturing here to these shores to avoid Trump's tariffs?
Well, thank you. First of all, thank you for having us today. I'm actually in the Smyrna plant today. We're celebrating the start of production of a QX60. You'll see two of them behind me. So it's an exciting moment. Absolutely, we produce a lot of vehicles in the U.S. We have 3 plants. Those plants are critical for our long-term strategy, and we're going to continue to produce them. For Infiniti, we will produce a new vehicle. We already announced next year a brand new vehicle called the QX65. Looks beautiful, by the way. I can't wait to see it out in the road. And it will be produced early next year here in Smyrna as well. And obviously, we have a plan for more vehicles coming toward our way here in the U.S. and in Americas.
You know, you mentioned 3 plants in the U.S. and then the Smyrna plant in Tennessee. What does this look like in terms of the ability to ramp up manufacturing, to create new jobs? There's a lot of question about the inclination to do so, given concerns about sales and the consumer and the impact of tariffs overall. What do you think that ramp up can realistically look like?
Well, for us here in Infiniti, we will continue to produce more vehicles. More vehicles generate more jobs. So you can imagine today, Infiniti produces the QX60 in this plant here. Next year, QX65. And in the lineup in the future, you will see more coming up. So the expectation is as we bring more vehicles, more volume in Nissan Motor Corporation inside the Americas, but specifically Infiniti will grow and will generate more jobs. So it will be positive for the society, for the state of Tennessee, the state of Mississippi, and all the United States.
Yeah, I recently drove the Nissan Armada for a week, and I was actually really impressed. The interior seemed dated, but it felt like a truck should feel. I also had the chance to drive the Infiniti QX80, which is a beautiful, or maybe handsome is a better word, vehicle that is truly luxurious. But I kind of missed the V8. Will you bring back a V8 now that it looks like we could have regulations loosened a bit?
Well, you know, first of all, the QX80, I love that vehicle. I drove one here today. The V6 turbo engine V6 that we have produces 450 horsepower. It's quite powerful. Right now, we're not planning a V8. Could we change our strategy? Potentially, but at this point, there's a lot of opportunity in the engine. There's more horsepower potentially that we can extract even from that engine with additional technologies. So at this moment, we don't see the V8 being the answer, but I'm going to tell you, there's more power out there.
I have a question about U.S. sales, because last year my understanding is that sales fell about 10%, about 1/3 of what was sold in 2017. How confident are you that you can boost the sales back to above 100,000 vehicles in a year? Do you see a path to that?
Well, this is a great question. It's something that I'm working intensively on. And really our mission for the next 5 years is this. We first need to improve the present, and we need to accelerate the future. We got to do both at the same time here at Infiniti. So what I mean by that is, with the current lineup, work very closely with our retailers and really simplify and intensify everything we do, okay? If it doesn't help us sell more vehicles, if it doesn't help take care of clients, if it doesn't help generate revenue, we should simplify. We shouldn't be doing. And then when I say planning the future, it's really take advantage of a new product renaissance that started with the QX80, and we're moving forward to this new QX60, QX65, and then we can launch one product per year for the foreseeable future. So there's a lot going on. We want to get there with 100,000 plus, and we're going to work really hard. One additional comment that is worth adding is, while we're doing all this, we're going to double down on client experience. Infiniti recently was ranked #2 in the industry, for the luxury industry, by J.D. Power on client satisfaction. just behind Porsche. We want to double down, and we want to be number one.
I have a good friend here, Tiago, Donna Wilson. She's always driven an Infiniti, and she switches her vehicles out every few years when they come off lease. Now she's worried about the financial situation of Nissan, the precarious situation that they seem to be in, and she's not sure if she wants to make that commitment again. How do you ensure the consumer that you're going to be around for the foreseeable future?
Well, nobody can say we didn't have a tough year last year. You saw the financial statement. But here's what I can tell you. We have a new CEO who I know very well, who's very capable. He's willing to make the tough decisions that are required to put the company back on track. We have a very solid plan, the Re-Nissan, that puts Infiniti as one of the priority companies inside of this strategy. And we're going to grow together. I am fully confident that we will build more vehicles in the U.S. We're going to continue to satisfy more clients, and everyone should be confident on that as well.
Tiago Castro of Infiniti, we thank you very much for joining us from Smyrna, Tennessee. Now let's get a look at some of the single stocks moving this hour. We've been talking about Rent the Runway. It's been soaring today. The company's bet on inventory is paying off, and those gains are just accelerating. It's up almost 34%, well into the market open, and now about more than an hour and 15 minutes in. We're watching DocuSign still tanking, down almost 19%. They missed estimates. This one's interesting to me, Matt. Robinhood. It has been on quite the tear. It is near its record highs, I believe right now, up another 2.3%. This is what people are watching out for. They're watching out for whether the online brokerage could become the latest firm to enter the S&P 500.
We're just seeing some really exaggerated, outsized moves in stocks today. When you look at Lululemon, when you look at Rent the Runway, when you look at DocuSign, which you have to say has a fantastic service.
You know what
right?
I'm going to say, right?
What?
We are still in the middle of earnings season.
Oh, no. Earnings season
still
is
in the season that never
over.
ends.
Coming up, the business of law is changing quickly and getting, as you might expect, more expensive. On today's Wall Street Week, we'll reveal how big law is pulling in big money. This is Bloomberg.
And it's time for our Wall Street Week conversation. Law firms pulled in over $343 billion in 2022, nearly $100 billion more than a decade ago. David Weston takes us inside big law, exploring how bigger cases and higher stakes are putting fresh financial pressure on the legal world.
The cost of litigation, the time litigation takes, the amount of investment either a law firm or the plaintiff has to make to even be able to figure out, is it a good enough case? How can I win this case? It just is cost prohibitive for the average person and frankly for the average firm, because a law firm that takes a contingency case, that's not their only contingency case.
Boris Zeisser is a partner at Schulte Roth, where he is co-head of its finance and derivatives practice.
I think it's the need for capital, given how expensive it is to litigate, that has created this need for this outside investment.
As the cases have gotten bigger and more expensive, so have the law firms that handle them.
Top law firm partners are being recruited from one law firm to another, and they're being paid something like $20 million a year, guaranteed for 5 years. I used to joke that law firm partners are paid like middle relievers. They're now being paid like starting pitchers. You start to have that in global enterprises, in dozens of locations with tens of thousands of people, if you count all the people who are not lawyers who work in these organizations. And pretty soon you realize that if you're running one of these things, you need not only the skills of an excellent lawyer, you need to also understand how to manage a complex business.
The transformation in the practice of law has already brought with it outside investment, largely in the form of litigation finance, where investors take an interest in individual cases or groups of cases.
Litigation funding is just the securitization of litigation assets. And again, it started out as a kind of cottage industry, mostly focused, frankly, on plaintiffs' firms who are looking for ways to defray the big investment. Increasingly, what we're going to see is, by the way, companies bringing them in to bundle cases together. So just like subprime mortgages, for better and for worse, we are now seeing, litigation as an aggregate asset in which people are bundling cases together, because from the company's point of view, it's an aggregate risk.
That was David Weston on how the practice of law is changing. You can watch Wall Street Week tonight and every Friday evening at 6 p.m. New York time.
It's what you need to think about. Now, coming up, the conflict between Musk and Trump hit Tesla investors hard, but may have hit ETF investors even harder. We're going to bring you more on that ahead. This is Bloomberg Open Interest. Elon Musk's feud with President Trump hit Tesla investors hard over the past 24 hours, but it's getting some ground today back. Over the 3 days, you could see looks tougher. Yesterday's pain, though, was felt even more by the people who invested in multi-levered Tesla ETFs. Joining us now, Eric Balchunas, Bloomberg Intelligence senior ETF analyst. We've talked so much about how on the way up, how good it feels to have that leverage, not so much on the way down.
Yeah, look, it's a double-edged sword. It always has been. And, you look at the people who trade this stuff, a lot of people, these traders like to pile into what just happened. So you should see a lot of volume in the 3X today, the long one. They usually look for this mean reversion bounce back. So for these degen traders who like using the 2X Tesla and the 2X inverse Tesla, a day like yesterday is like the perfect situation. If you're caught on the wrong side of that, or you're holding the positive one yesterday, it's a bummer, but just volatility in general, they love it. So TSLL traded $6 billion worth of shares, its record volume. And get this, if it were a stock, the 2X Tesla ETF would have been the 6th most traded equity on the New York Stock Exchange, which was wild to me.
What about the borrow? I mean, do you see people shorting these ETFs?
Yeah, it depends. I mean, that's why the 2X stock ETFs are so successful, because you could just click buy, and now you're negative 2X Tesla or 1X Tesla, whatever you want. The borrow usually is, when the borrow gets high, that's usually why some of these products succeed, even from the pros. But I haven't seen the borrow cost on Tesla itself, go up too extremely. So if you wanted to borrow, these liquid stocks are pretty easy to borrow. But here's the thing, if you're someone at home with your brokerage account, it's just easier to click one thing and have a trade put on for you.
It's interesting. It's not just the levered trades, too. It's, as you pointed out, Elon, US. That is a ticker in itself. It's where you're trading Tesla versus Ford. How closely are you watching that? I know it's tiny compared to the rest, but are there more things like it?
Yeah, so I forgot this thing exists, but then I saw that Elon had been halted, and I was like, oh, yeah, that's right. It's the battle shares, Elon versus Ford. Battle shares are where they put two stocks against each other, sort of like trends, like EVs versus old school. So Elon was down 27% yesterday, bad day, but the ETF traded 10 times its normal volume. So even for the issuers, sometimes even this horrible day for this ticker might just be what the doctor ordered in terms of getting some volume going, which then can attract more medium-sized fish to it.
All right, Eric, great to spend some time with you, and I look forward to your program on Monday. That is ETF IQ. You can catch it every Monday at noon New York time. And I believe there's a newsletter as well that goes with that. So if you haven't got enough, plus you can follow Eric on Twitter. You follow Eric on Twitter?
I actually have alerts for just a few people, and that includes Eric Balchunas, Elon Musk, Brian Armstrong, and so for me, Eric is of
he's up there with some pretty big dudes.
Things to say, exactly.
Coming up on Monday, I'm happy to say we have RBC's Lori Calvasina. It's always great to talk with Lori. We have Goldman Sachs' Peter Oppenheimer, which will be pretty fantastic. Health Equity CEO Scott Cutler. So we got a lot coming up on Monday, and maybe we hold these gains into the close, Sonali. Maybe we stay over 6,000 through the weekend.
Yeah, it's incredible. I've been thinking about how long I've been saying this for, when we're going to hit 6,000 again. You pointed out to me last time we were at 6,000 was back in February. We're back into bull market territory, even with yields higher. So interesting setup into next week before we get that CPI data.
Perfect timing. Today is the 6th of June. So 11 more days until bullish launches.
Yes, right into that bull market.
This is Open Interest.